Greetings, everybody. Welcome to Liberty Call. I'm Raymond Dahlman, your humble host, and it is, what day is it? Wednesday, Wednesday, June 7th, 2023. Hope everybody's having a fantastic day out there. It's a little overcast here in Colorado. We got more rain coming. We got some sort of it's actually coming from the east, and I think a lot of the storms coming up, through the Gulf, and then they're kind of looping around and heading back west towards us. And then when they hit the Front Range where I live, the clouds go up and it drops a ton of water. So it's been an interesting few weeks here, which has not been a whole lot of fun. Anyway, my grass is, I trimmed it last week, and it looks like, we're in the middle of the jungle already. So, all righty. Well, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, likes, shares, subscribes, follows, press all the buttons down here at the bottom. I would greatly appreciate it. Kind of a meh day in the markets. The Dow finished in the green, but the S&P and the NASDAQ were in the red. And see a lot of red across most of the major indexes across the world. So let's go ahead, jump in and take a look. All right, Dow Jones was up 0.27%, 91 points, closed at 33,665. The S&P 500 was down 0.38%, closed at 4267. NASDAQ was down 1.29%, closed at 13,104. The VIX was flat at down 0.07. It's currently at 1395. Canada was down 0.36%. Brazil was up 0.83%. Mexico was down 0.23%. Over in Europe, Germany was down 0.2%. The UK was flat at down 0.05%. France was down 0.09%. Netherlands was down 0.08%. Spain up 0.53%. Italy up 0.07%. Switzerland down 1.05%. And Portugal down 0.28%. Russian exchanges were mixed. The MOEX was up 0.5%. The RTSI down 0.22%. In Asia, the Nikkei in Japan was down 1.82%. Australia was down 0.16%. New Zealand down 0.65%. In China, the Shanghai was flat at up 0.08%. The Shenzhen component down 0.6%. China A50 down 0.63%. The DJ Shanghai was flat at down 0.04%. Hang Seng up 0.8%. And the Taiwan weighted up 0.96% for the day. All right. So all in all, not terrible, but, probably more red. People are, really worried about where things are going to go. And, we get the government and the media like, it's fine. Everything's good. I mean, you remember that inflation? It was just transitory. Nothing to worry about. All right, let's go to the market recap. S&P 500 slips as tech melt up cools. On Wednesday, the S&P 500 experienced a slight decline as the tech sector's momentum waned, offsetting gains in the energy sector. Investors were anticipating the Federal Reserve's upcoming decision scheduled for the following week. Tech giants Apple saw a 3% decrease, leading to a slide in the tech sector as investors appeared to take profits after the sector's year-to-date gains of over 30%. Similarly, Amazon weighed down the market despite reports suggesting the company's plans to launch an ad-supported tier for its Prime Video streaming platform. In contrast, Warner Brothers Discovery and Paramount both climbed, fueled by reports of negotiations with Amazon to include an ad-based tier of their streaming services through Prime Video. Affirming Holdings experienced gains related to Amazon-related news as it announced the availability of its adaptive checkout feature to merchants using Amazon Pay, enabling personalized payment options for customers. Probably don't want to do that in San Francisco. They just walk out with the stuff. I don't think there's a lot of honest people in those blue cities. Energy stocks continue to rise, building on recent gains due to Saudi Arabia's decision to reduce production and unexpected drops in U.S. crude stockpiles. Where'd it go? Did it just disappear? Maybe there's a leak in those tanks. Earnings reports also influenced the market, with Campbell Soup reporting quarterly results surpassing Wall Street estimates. Yet people, money's tight. People are buying soup. However, the consumer staples company reaffirmed guidance fell short of expectations, resulting in an over 8% drop in its shares. Stitch Fix rallied 30% after reporting narrower than expected losses in the third quarter, attributed to cost-cutting measures probably the first quarter. The cost-cutting measures that improved margins. However, concerns were raised about the ongoing client losses following a 20% decline in quarterly revenue. In the crypto-related sector, Coinbase experienced a 3% increase after Cathie Wood of ARK Investments purchased the dip following the U.S. Securities and Exchange Commission's lawsuit against the cryptocurrency platform. for allegedly operating as an unregistered exchange. The market's slight decline occurred a week ahead of the Federal Reserve's meeting, where it is widely anticipated that interest rates will remain unchanged. We shall see. I know some of the Fed governors have, especially St. Louis Bullard, he's very hawkish, wants to keep raising rates. Then you got the doves like Lael Brainerd, who is, she looks like the Crypt Keeper. Or from Beetlejuice, remember the woman who smokes and down in the wherever Beetlejuice went, it had like the slash across her throat and she'd smoke and the smoke would come out through her neck. So she kind of looks like that. All right, next up, U.S. trade deficit widens to 6-month high, expected to hit economic growth. That doesn't sound good. In April, the U.S. trade deficit recorded its largest increase in 8 years, signaling a potential drag on economic growth in the second quarter. The Commerce Department reported that the trade gap widened by 23% to reach $74.6 billion, not the highest. It was over $100 billion during the COVID crap. The highest level in 6 months. The surge in imports and decline in exports, particularly in energy products, contributed to the significant increase. Economists predict that the trade could subtract as much as 2.5 percentage points from GDP this quarter, unless imports reverse course. The strength of domestic demand and challenges such as the strong dollar and a slowing global demand could continue to affect exports. Economists, including Christopher Rupke, chief economist at Forward Bonds, expressed concerns that the worsening terms of trade could bring second quarter estimates of real GDP closer to the critical 1% level. The revisions to the trade data for the first quarter indicated that the trade deficit was not as large as previously estimated, leading to expectations for a higher GDP growth estimate for that period. In April, goods exports increased by 2% to $263.2 billion, driven by motor vehicles, parts, and engines. Imports of consumer goods and industrial supplies and materials also rose, while petroleum imports reached their lowest levels since August of 21. On the other hand, exports of goods experienced a significant decline of 5.3% in the most in 3 years, reaching $167.1 billion, the lowest level since February of 22. Slowing global demand and the recent strengthening of the U.S. dollar against major trade partner currencies have impacted exports negatively. The trade deficit with China widened to $24.2 billion in April from $24.2 in April from $22.6 billion in March. The ongoing West Coast port labor negotiations, which have caused temporary disruptions, could also impact trade data in the coming months. So, not great. But kind of how I explain it to clients is, we always talk about in our every 4-month meetings, we talk about, kind of the state of the economy, the health of what's going on, what's doing well, what's not. And I always, show the chart of the trade deficit. But kind of the way I look at it is right now is, we are we are importing their stuff and sending them our dollars. And if you've been paying attention all along, with the inflation of the dollar, we are sending them our worthless currency for goods. So it's not really that terrible of a deal. Now there will come a point at some point here in the future where, unless, the Fed and our government comes to their senses and acts like responsible people in charge of this sort of stuff. But if it continues as it is, there will come a point where, other countries will be like, nah, I don't want the dollar. Give me gold, give me silver, give me Bitcoin, whatever it might be. But for right now, it's not a terrible deal. We send them our oops, the power just clicked off. So we send them our worthless currency, and then they send us it's going to get loud here for a second as all my printers come back on. Anyways, so I wouldn't worry about it too much. All right, next up on the docket, credit card debt keeps surging even as interest rates hit record high. All righty. I'll let that spool for a second. See, I have like my computer, my phone, and all that good stuff on a battery backup here that lasts for a couple of hours if the power does go out, and also the Wi-Fi here in the house. But my printer, no, it's plugged into the closest outlet, and it makes this ridiculous noise. So, all right, well, let's go ahead and dive into the summary here. The latest consumer credit data released by the Federal Reserve indicates a continuation of concerning trends in the U.S. In April, total consumer credit reached a new record high of $4.86 trillion, increasing by $23.1 billion and growing 6.8% year on year. Revolving credit, which primarily consists of credit card debt, rose by $13.5 billion, bringing credit card debt to a new record high of $1.244 trillion, a 13.1% increase from the previous year. Non-revolving credit, which includes loans for items such as vehicles and education, increased at a slower pace of $9.5 billion, below the recent monthly average. The surge in credit card debt is notable given that the average credit card interest rate have also reached a record high of 20.9%. It's unclear whether consumers, sensing this as their last opportunity to spend freely, are maxing out their cards at an unprecedented rate, or if the banks are aggressively issuing cards in an attempt to pile on more debt. In contrast to the increase in credit card debt, demand for auto loans has plummeted. Auto loans saw a major increase of $13.9 billion. A meager increase, the weakest quarterly growth since 2020. The decline in demand can be attributed to the high interest rates attached to auto loans. These trends set the stage for a potential future crisis and credit crunch, just as Americans struggled to afford their mortgages in 2008 and hoped for a bailout or a chance to walk away from their debts. A similar scenario may be unfolding with credit card debt. Individuals may be maxing out their credit cards knowing that they will be unable to pay the debt, but hoping for a future financial crisis or government intervention will provide an opportunity to escape their obligations. Shocking that the public would do something like that. The combination of record high credit card debt, soaring interest rates, and a slump in auto loan demand raises concerns about the financial well-being of the U.S. consumer and the stability of the credit markets. All right. Well, that's certainly good news. And having in my prior life, before I became a financial advisor, I was a credit and collections agent, associate, whatever you want to call it. So spent 8 years, started off, just, hey, you're late on your bill. Quickly moved to the harder to collect stuff. And, I guess the last 4 or so years, I did a lot more recovery, dealing with charged off accounts, attorneys, things like that. So, there's a whole industry behind people not paying their bills. So anyways, but typically when, delinquencies rise, all these things work in kind of cycles. As the economy starts to trend down, then delinquencies start to go, or balances and delinquencies start to go up, and then, creates a lot more work for, people who are collectors and recovery agents. So anyways. All right, last article here. 4 Social Security shakeups from Biden that could hit your wallet by 2024. President Biden has proposed a 4-point plan to address the funding shortage in the Social Security Old Age and Survivors Insurance Trust, which is projected to be depleted by 2033, which is only 10 years from now. The 2023 trustees report highlighted a funding shortfall of $22.4 trillion, and if not addressed, it could result in a 24% reduction in benefits for retirees starting in 2033. Biden's plan includes changes that would primarily impact high earners and company executives with substantial retirement savings. However, there are also provisions that would affect middle and lower income wage earners, particularly those who rely on Social Security benefits in the future. One proposed change is to implement a payroll tax for income over $400,000. Currently, income up to $160,200 is subject to the 12.4% payroll tax, but earnings above that amount are not subject to the Social Security taxes. Biden aims to tax earned income above $400,000, leaving wages between $160,000 and $400,000 untaxed. Another aspect of the plan involves modifying the calculation of cost of living allowances. Increases. Currently, COLA is determined based upon the Consumer Price Index for urban wage earners and clerical workers, which may not accurately reflect expenses of retired individuals. Shifting the calculation to the Consumer Price Index, switching the calculation for the Consumer Price Index for elderly could provide more appropriate adjustments for retirees. Well, why not just base it upon the inflation rate? Let's see here. Biden also proposes increasing the primary insurance amount, PIA, for Americans aged 78 to 82. The PIA indicates the amount Social Security benefits an individual will receive based on their age of claiming and average indexed monthly earnings. This increase would help individuals facing rising expenses such as healthcare later in life. Additionally, Biden aims to raise the special minimum benefit for lifetime lower wage workers. Currently, a lifetime lower earning worker would receive $12,402 annually in Social Security benefits. The plan seeks to increase the minimum benefit 125% to the federal poverty level, providing more support for those in need. However, It is uncertain whether the plan will pass Congress. I highly doubt it, as bipartisan support would be required for a Social Security overhaul. Democrats and Republicans have yet to find common ground on a way to strengthen Social Security funds while simultaneously increasing benefits for those who require assistance. Yeah, it's a big Ponzi scheme. Most of us, people my age, I'm 49, never going to see a dime. Unless the government gets their crap together, pays off all this debt, and then we have a bunch of free cash flow, coming through the government that, we can afford to do this. I just don't see it working. And frankly, I would have liked the option to have opted out. I could probably, being an investment advisor, probably do better than the crappy return that you get on your money from the government. So, and especially since they spend it, your money's not there anyways. Alrighty. Well, if you need to get your finances in order, go to dsafinancialgroup.com, book a meeting, and I can help you get your finances back on track for retirement, kids, college, whatever. Maybe buy a new house. All right. Well, that's all I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.